Have you ever thought to yourself, I need to start investing, but then immediately felt overwhelmed? You hear terms like stocks, bonds, ETFs, and market crashes, and it all just seems too complicated, too risky, or something only for the rich. Well, I'm here to tell you that's not true. Investing is one of the most powerful tools you have to build wealth, and it's more accessible today than ever before. The goal of this video is to demystify the entire process. We are going to break it down, step by step, into a simple, actionable plan. So if your New Year's resolution for 2026 is to finally become an investor, you've come to the right place. Part 1. The mindset shift, from spender to investor. Before we even talk about where to put your money, we need to talk about the most important tool you have: your mindset. Investing isn't a get-rich-quick scheme. It's a get-rich-slowly and surely plan. It's about playing the long game. Think of it like planting a tree. You don't plant a seed and expect a giant oak tree the next day. You plant it, you water it, and you give it time to grow. Your investments are the same. You're planting financial seeds that will grow over years, even decades, into something substantial. The key to this growth is a magical little concept called compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. You earn a return not only on your original investment, but also on the accumulated returns from previous periods. It's a snowball effect. Your money starts making money, and then that money starts making more money. That's why starting early, even with small amounts, is so incredibly powerful. $1 you invest today is worth far more than $1 you invest 10 years from now, because it has more time to compound and grow. So the first step is to shift your perspective. We are not gambling. We are building for your future self. Step 1. Create a simple budget. I know, the B word. But you can't invest money you don't have. You need to know where your money is going. This doesn't have to be a complicated spreadsheet. Just track your income and your expenses for a month. How much comes in? How much goes out? The goal is simple. You need to be spending less than you earn. That leftover amount is what you can use to build your future. Step 2. Build your emergency fund. Life happens. Your car breaks down, your pet gets sick, or you face an unexpected job loss. An emergency fund is your financial safety net. It's 3 to 6 months worth of essential living expenses saved in a high-yield savings account. This is not investment money. This is cash that is easily accessible and protects you from having to sell your investments at a bad time to cover an emergency. Step 3. Payoff. High-interest debt. Not all debt is created equal. I'm talking about high-interest debt like credit cards or payday loans, often with interest rates of 15%, 20%, or even higher. It's nearly impossible to outinvest that kind of interest rate. Think about it. If your credit card charges you 20% interest and you're hoping for an 8 to 10% return from the stock market, you're still losing money. Make a plan to aggressively pay down any high-interest debt before you start investing heavily. Stocks. When you buy a stock, also called a share or equity, you are buying a tiny piece of ownership in a public company like Apple, Google, or Amazon. If the company does well, the value of your piece can go up. If it does poorly, it can go down. Stocks offer the potential for high growth but also come with higher risk. Bonds. When you buy a bond, you're essentially lending money to a company or a government. In return, they promise to pay you back the full amount on a specific date, plus regular interest payments along the way. Bonds are generally considered safer and less volatile than stocks, but they typically offer lower returns. Index funds and ETFs. Now, this is where it gets really exciting for beginners. Instead of trying to pick individual winning stocks, which is very difficult, you can buy an entire collection of them in one go. And Forrester Index Fund is a type of mutual fund that aims to mirror the performance of a specific market index, like the S&P 500, which is made up of the 500 largest companies in the US. By buying a share of an S&P 500 index fund, you instantly own a tiny piece of all 500 of those companies. It's instant diversification. For 99% of beginners, starting with low-cost broad market index funds, or ETFs, is the simplest, most effective, and most recommended strategy. Part 4. How to actually start. Opening your account. So, where do you buy these investments? You need to open an investment account, commonly called a brokerage account. Think of it like a bank account, but instead of just holding cash, it can hold stocks, bonds, and funds. In 2026, opening one is incredibly easy and can be done online in about 15 minutes. Low or zero fees. Look for brokers that offer commission-free trading on stocks and ETFs. 2. No account minimums. Many brokers now let you open an account with as little as $1. 3. Ease of use. Choose a platform with a website or app that you find easy to navigate. The process is simple. You'll provide some personal information, link your bank account to transfer money, and you'll be ready to go. Part 5. Your first investment strategy. You've got your account open and funded. What should you actually buy, and how should you do it? My advice is to ignore the noise. Ignore the hot stock tips from your cousin and the people on the internet promising to make you a millionaire overnight. Your strategy should be boring, consistent, and automated. It's called dollar cost averaging. All this means is investing a fixed amount of money at regular intervals, say $100 every month regardless of what the market is doing. When the market is high, your $100 buys fewer shares. So, a simple plan for 2026 could look like this. That is your simple 5-part plan to go from a complete beginner to a confident investor in 2026. 1. Shift your mindset. Think long-term and embrace the power of compound interest. 2. Build your foundation. Create a budget, build an emergency fund, and crush high-interest debt. 3. Understand the basics. Start with simple options like low-cost index funds or ETFs. 4. Open an account. Choose a low-fee broker that's easy to use. 5. Use dollar-cost averaging to invest consistently and ignore the daily noise. The most important step is simply getting started. You don't need thousands of dollars. You can start with $20. The key is to build the habit. Your future self will thank you for the small steps you take today. If you found this guide helpful and it cleared up some of your confusion, do me a huge favor. Please hit that like button. It really helps the channel out. And for more simple guides on managing your money and building wealth, make sure you subscribe to my channel and ring that notification bell so you don't miss a thing. Do you have any questions about starting your investing journey? Let me know in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.